Hi, I'm Tal Salamatia, and thank you for selecting my course. I've got over 15 years experience in entrepreneurship, and I'm here to share that experience with you, starting off with this course on finance. So without further ado, let's dive in. So I like to start off with just a blank document. Today, Numbers, which is what we're using, has a ton of different templates to choose from that, to be honest, I haven't really explored because I like to start from scratch and do it the way I've been doing it for decades. So yeah, let's start off with a blank document. Alright, let's maximize that. So first thing we're going to want to do is create 3 of these guys. The first one we're going to name as a summary. Alright, second one we're going to rename as cash flow. And the third one let's rename as revenue. Alright, so the summary page we're not going to touch yet because that's the last thing we're going to do. First thing we're always going to want to do is go over costs. And the reason why we do that is because you always know what your costs are going to be because you have to open up your wallet to make those operating or capital expenditures. Now on revenue side, that is a lot more difficult to predict because you can't guarantee anyone is actually going to pay for your product. But, you know, we always hope that they will. So let's start off with the first thing that I always think about is labor. And labor, if you are familiar, is an operating expenditure and let's make this a little bit more readable. Okay, so within labor you have person 1, person 2, and then if you highlight these 2 then you can expand it, but you're limited to how many there are already there, so let's draw this down. Now, what other things are operating expenditures? Well, you have your basic overhead things, right? So head minus labor, because we already have labor over here. Now, what we're going to want to do here is think of all the things that your business will have to pay for, which is like rent. We have insurance. We have cost of goods sold. And we also have, just a bunch of random stuff like utilities. Each business is different, so it's kind of hard to have a template that fits every scenario. So let's keep this the way it is. And then after we have our operating expenditures, we have capital expenditures. These are things that you buy, like computers, office equipment that you're not renting, that you actually own. Let's say IT equipment. And let's say patent. This can be an operating expenditure or a capital expenditure. In this case, I'm calling it a capital expenditure because we are going to say that we purchased it. That question about whether it goes into operating or capital expenditure is really up to your bookkeeping and accounting practices. As long as you stay consistent and have a good rationale, then it's all good. Business is always more of an art than a science anyways. So let's do our timeline. Let's start off in month 1 and month 2. Highlight these, draw them out, and let's draw this out a while. Alright, 11, month 12. Alright, year 1 total. Two, 3, and year 4, and let's do year 5 just to have a 5-year projections. If you notice, I will do automatic fill all the time. Alright, so let's say person 1 needs to start off in month 1 and we are paying them $5,000 a month. Ooh, almost forgot to do the formatting. And let's highlight all of this because it's all gonna be numbers. So cell, currency. I don't like decimal points because when you're dealing with large numbers, it's really pointless. Alright, I like thousand separators, and I also like accounting style format with the dollar sign. I don't know why, I just do. Alright, so to make it easy, I just do equals this cell, enter. Oh, and what do you know? It just populates. So then I can extend this out to here. And then this was equals sum of all of this. Enter. And it sums it all up nicely for me. Now we're gonna want to do that same formula for everything here. So let's fill in this. And you have equals sum because you want to know what your total for all your labor is. Then you highlight from here to here, press enter. You got your yearly total, or your first year's total of what your salaries are going to be. Now, one thing that we're going to want to do on top of that is do a monthly one. So, easy way to do that, just grab this guy because it's already summing that column and drag it all the way to the end. Alright, let's add a row below, another one, just get some more breathing room. And this is going to be total pre-tax labor. And this is going to be with your labor costs associated. So this is a real labor cost. And you can basically just assume that that's plus 30%. Basically 28%, but rounding up to 30 is always nice. So you just go this equals that times, you can't just do times 0.3 because then you're just getting the taxed amount. What you want is the pre-tax total plus the benefits and other taxable liabilities that you have per employee. So that would be 1.3. Enter. Drag that across all the way And voila, you got that. Now, year 2 and 3 and 4, let's say people are going to be getting a 15% raise, and the problem is not everyone is working the whole year. I mean, these people are only working 4-5 months, from month 5 on. So you can't just multiply this by whatever the raise would be. What you have to do is go equals this times 12, which would be your yearly salary. Make sure you have your parentheses to keep things clean, times. And we said we wanted to do a 15% raise each year. So enter, and that's their new salary. And there we go. And we want that still to be a summation, so we'll take this over here. And this is going to be a little bit different, so it's this times 1.15. And you have that, and then you got that. And poof, it's populated. Some people like to put zeros in there just to make it look nice. I'm one of those people. Oh, trick, if you press shift and arrow key, you can highlight more cells. Now, let's move to the next area, which is overhead, not including your labor. So, we have rent. Let's say we're going to be spending a conservative $2,500 a month for rent of a space big enough to have 6 people. So we will pull that out all the way to here. And we want that summation thing, right? So we just copy that and we paste that. And it doesn't actually copy the number, it copies the formula. And the formula was that it's summing this whole row. So that was really convenient. Now I'm just going to draw this down, and I can see that it's only going to row 18, which is what I want. And voila. Insurance, let's say we're going to be breaking that down, that yearly cost, into months. So that's going to be about $1,200 a year, so about $100 a month. Okay, and cost of goods sold is going to be populated from the revenue tab, so leave that blank for now. And utilities, we'll say that's going to be $200 a month. We're going to use a lot of utilities. Okay. Nice. And then I was dragging it, but the better way to do it is actually to go equals this and then drag that. Both ways work equally fine. And then we have our add row below, and we have total overhead minus labor. Got to be accurate. Equals sum of all these guys, and pull that all the way across. And voila, got that. Let's say we want expenditures to increase at the same rate that other things are increasing. So let's say that's 15%, so let's say 20%. So equals that times 1.2, which is 20% increase. Alright, there and there. We don't want that one because that one's going to be populated from somewhere else. So copy that formula and paste that formula, and then we bring it down. Alrighty then, and then pull this out. Okay. Capital expenditures, let's see, we have 6 people. A MacBook Pro is like $1,500. So let's say conservatively we're going to be spending $20,000 on computers and another $10,000 on operating office equipment, then another $15,000 on IT, and let's say we spent $100,000 on this patent. Okay, so there's not going to be ongoing, really, right? Because you just spent that money, and you're not going to have to spend that money again. But let's extend this all the way out here. However, let's say we want to get some new IT equipment in month 8 or so we'll add another $10,000 here. And let's say want to buy some more office equipment, so add another $5,000 here. Okay. Now we want the summation formula, so you just copy that. V. Okay, bada bing, bada boom. And what do we want again? Oh yeah, we want to sum that whole column. So it equals sum, highlight, enter, drag, pull, and voila. Let's say these capital expenditures are going to increase by double, all right, times 2 every year. Healthy capital expenditures. And as you can see, that really starts being a lot over here. So maybe not as many computers. So let's say we want to keep computers at around $30K a year, no matter what. Actually, I should have just done equals value, enter. There you go. And let's say this is just going to cap at 100K. And same thing with that, or actually alright, that looks alright. Cool, so we have our cost pretty much figured out. Label. So one thing we're missing, add row below, we want total operating expenditures. And what is that? That is your real labor cost plus your total overhead minus labor costs, which would be your total operating expenditures. And take that all the way out here. And then we have our last thing we need to do to get EBITDA, which stands for earnings before interest, taxation, depreciation, and amortization. You don't have to really worry about depreciation and amortization unless you have other types of securities like debt or investment vehicles. So we can easily think of it as earnings before interest and taxation. And that's basically just your revenue, which we'll be talking about next, minus your operating expenditures without taking capital expenditures into consideration, which we will be talking about next. So before we go into revenue, I want to talk about EBITDA. Everyone thinks about top and bottom line numbers. top line being your revenue and bottom line being your profit. I really think that EBITDA is a much better way of valuing a company and understanding the profitability of a company, because so many companies use capital expenditures to hide profit. Amazon is a great example of this. Amazon was making decent money but wasn't showing a profit and wasn't exiting any of that money to their shareholders. They were just reinvesting that money through capital expenditures into servers, which now is AWS, and that is their largest cash cow. EBITDA doesn't take capital expenditures into account, so it's basically a indicator that shows how your operating expenditures impact your revenues, which is, I think, more important than taking a look at profit, which, as I just mentioned, can be obscured through the use of capital expenditures. So, next up, revenue. All right, so because we have this nice area up here all figured out in our months and our years and everything, just copy that. You know it goes to R, so here, take this out to R, highlight that, and V, and we are already formatted, ready to go. All right, so first thing you want to do with your revenue slide or tab is talk about your assumptions. So we got our assumptions, and to fill out assumptions, we got to kind of figure out what type of business we are going to be in today. Let's say we are in a business of making widgets, and widgets are a piece of hardware that is manufactured, and we can assume that the marginal cost per unit is, and then we can expand this out, and let's say the marginal cost is $5. And let me do some formatting real quick. Alright, so we don't want automatic, we want currency. And we don't want any decimal points. And we do want thousand separated, and we do want accounting style. Alright. And this is going to equal to that, and that's going to get pulled out all the way. And it's important that that is above on each column, because when you're doing formulas that refer to this later, it's really important. Now the other thing I'd like to do is color code. So we'll get into that later. Right now, I want to show you that anything in yellow, go ahead and edit. That makes it easy to collaborate and have multiple people working on your document. If you have yellow cells, it makes it really easy for people to know what they can mess with and what they should not mess with. Okay. Now, let's say your sales price per unit, I should be consistent, and let's say that is $40. Alright, and then we want this to do the same thing as this does, and then we are going to make some more assumptions. Let's say that in addition to the sales price of this unit, let's say we have another type of product too. So let's say we have per widget 1, And let's make sure we are doing widget 1 over here. And then we want it basically the same thing for widget 2. So let's try and copy that. Copy that. Alright. So we can make these 2 yellow as well. And let's say widget 2 is $20 to produce, but we can sell it for $500. Cool. So we can extend this out and extend this guy out. All right. Sales. And this is W1. We want widget 1 sales. And let's say we have 1 sale. And actually, we want to change this because it's not dollars. It is a number. It's just 1. So then we want to take this number and put it all the way out just so we have a placeholder. Now what does it mean when you get a sale? That means that you are going to incur cost of goods sold. Ooh, messed that one up. Just put cost of goods sold W1, and that is just going to be the number of sales times the marginal cost per unit. So it's $5. And we can go ahead and extend this all the way out. Okay, say revenue of W1. What is that going to be? That is going to be number of sales times the sales price. There you go. And you extend this all the way out. Okay. Now we just want to basically copy these things. Copy and paste. Oh, I forgot to highlight 3 to paste 3. There we go. And oh look, it's copied the formula, but that's the wrong formula, right? So what we're gonna want to do is double click, and then we can just drag this to that guy, enter, and pull this all the way across. And what's that? Oh yeah, that's wrong too. So double click, pull that over there, enter. Alright. Extend that all the way over here. Okay. Now, now that we have the model kind of figured out, actually we're not quite done with the model. Okay, so this is I keep on doing that. Let's say gross revenue. And that's just the total amount of money that you're pulling in, which is that plus that. And you're gonna want total cost of goods sold, and that is gonna be that plus that. And what we're gonna want is your net rev, and that is just going to be gross rev minus your cost of goods sold. There you go. Now I've been pulling them out one by one, but if you do it this way, you can just pull them all out, and it works great. Cool. So now we have our model done. What we got to do now is figure out these sales numbers. Dun dun dun. Because all of these sales numbers need to be figured out for your business, and each business is different. Each business has a different ramp up, and you just got to be realistic, because if you're not realistic, then your investors won't believe you, and they won't give you their money, and none of this will happen, or none of what you hope would happen will happen. So let's say we're actually just not going to make any money the first few months, so we're just going to like zero that out. And then we start off one sale, then we go to we get a good contract and we can sell 100 of them, and then we sell 20 of these because they're a little bit more expensive. And now let's start a growth curve, so now we can start selling 200. We're doubling, so let's go double. And then let's say we start ramping up our J-shaped curve, and J-shaped curve looks like the letter J or a hockey stick. And so let's just fill this into 350, and this is up to 60, and then so this equals sum of that dragged out Alrighty then. You see how important putting the model together first is? Because we just filled in those numbers and wow, look, all this stuff populated. So now let's figure out what this growth rate's going to be. Let's say it's going to be growing at that times 12. So you get your annualized based on your last growth rate. Many people try to just do it off of the year one total, and it's totally wrong. You're not going to get the numbers that you really need. 1.6, say. Alright, copy that, paste that, and then you want this to equal, go at that rate, 1.5. All right. So, total cost of goods sold. That might sound familiar. That's what we're missing over here, right? So this is equal to that guy. Make sure it's in month 1, enter. Then you can just pull it all the way out. You got your costs. And what do we want to put up here? Revenue. Alright. One thing that we also need is add row above. Add row above, get some breathing room, investment. So let's say you brought in $1 million just to have a placeholder. Oh, format. Currency. Oh, I don't want any zeros there. 1,000 separator, county style. Oh yeah. Alright, let's add a row below. EBITDA equals revenue minus total operating expenditures equals negative. Totally okay. Next, you have your investment total plus your EBITDA minus your capital expenditures. And what is that? That is cash on hand. Alright. Okay. Got these guys formulated up. Now pull that all the way over here. And what do you know? Oh, I forgot something. This formula is not quite right. You got to also add in your previous month's cash on hand. There you go. Now that formula is right. Alright. Cool. Main thing you want to do is make sure that this cash on hand is never negative. Starts going negative, but never really reaches full negative. So that means let's try seeing what the minimum investment we need in order to continue would be. Let's say how much we're dropping. We're dropping by about a little over $250,000. So 300,000 or 400,000 should do the trick. Let's see, 400,000. And what do you know? You stay positive. So that's how you know how much you need in order to get to where you gotta go. However, that is not necessarily the best way to do it, because you're assuming that revenues are going to occur. If you want to be super conservative, and this doesn't really always work, but typically you can just add up your operating expenditure and your capital expenditure for the first year to know what you really need. So about $500,000 in operating expenditures and $160K in capital expenditures. So as long as you raise about $700, you have a full year's worth of costs. And as long as you can start making revenue or get your break-even point before that cash expires, you should be okay. So that's finance in a nutshell. Oh, almost forgot. Summary page. You don't really expect a investor to have to go through all of this to figure out what, you know, your company is doing in a split instant. So what you want to do is you want to talk about the most important things. Let's let's not do it that way. Let's pull this out a little bit. And you got your revenue. You have your labor. You have capital. that, you want to talk about EBITDA. All right, cash flows. This is just going to be your yearly totals. So that's that. Oh, so this is 1, 2, 3, 4, and 5. And we don't need this guy, so delete. So sad. Bada bing, bada boom. Labor equals cash flow total, and total real labor is what you're going to want. Make sure we know it's a real, and this one is right about there. And that is here. Oh, I think I got the wrong number for this guy. You don't really want any calculations to be done on that page. You just want it to be populated from other places because there's too big of a chance of error otherwise. Okay. Sweet. We don't need any of these guys. And NPV. Dreaded net present value. Alright, so what discount factor are we going to use? To be super conservative, let's say we want a 40% equals 40%. Okay, so how do you do net present value? Net present value, or what is net present value? Net present value is essentially what a future cash flow is worth. So what is $125.5 million worth today? And what are all of these cash flows together worth today? This discount factor lets you know, say that dog. This discount factor lets you know how to value that future cash flow. Alright, so net present value is basically how you value future cash flows. What we want to do is we want to use EBITDA, and we say equals EBITDA divided by parentheses 1 plus the interest rate to the power of the year. Now, that was year 1. This is going to be year 2. So to the power of 2 to the power of 3 to the power of 4 and the power of 5. As you see, these numbers are dramatically smaller. That's because the discount factor we chose. If we wanted to pick a different discount factor, like let's say we wanted to pick a discount factor that was a little bit less conservative, let's say at 20%, look how much those numbers increase. But in order to make investors know that you're being very conservative, you use a higher discount factor. Now, what is the total value? So valuation equals sum of these 5-year future cash flows, 36.2 million. So voila. There are other methods for valuation. If you're interested in learning more about valuations, please watch the class on valuations. And if you are interested in anything else, just look at all the content I have.